Merci, Madame Courville. Bonjour, Mesdames et Messieurs. L'exercice 2014 a été une autre année.
Fiscal year 2014 was another year of excellent performances. We had a net result of 140 billion or 140 share, but excluding the adjustment having to do with the structuring and the trustee, we have an adjusted net income of 136.6 million or 5.31 per share. We will return on adjusted common shareholders where equity was 11.9%. The performance translated into another record year for the bank on an adjusted basis. Our results are attributable to disciplined cost control, our solid credit quality, and to the effectiveness of our market development strategies. From a cost standpoint, the bank pursued its efforts to optimize its processes and increase its overall efficiency. Excluding adjusted items, which include operating expenses associated with the integration of the AGF trust operations and restructuring costs, our adjusted efficiency ratio improved markedly from 70.80% to 71%. We also remained very satisfied with the credit quality of our loan portfolios. In 2014, the provision for loan losses stood at $42 million, which represents a ratio of provision for loan losses as a percentage of average loans and bankers' acceptances of only 15 basis points, better than the six largest Canadian banks' ratios. In addition, the bank posted solid balance sheet and capital. Loans and bankers' acceptances totaled $27 billion at the end of fiscal 2014, representing 47% increase over the past 5 years, and deposits were valued at $24 billion, up 34% over the same period. These results were attributable to both internal growth and our strategic acquisitions. With respect to our balance sheet, one of the important elements of the bank's strategy over the past few years has been the diversification of its operations. Today, the distribution by sector and geography of our loans and our varied and balanced sources of deposits constitute a major strength. In light of this increased diversification, approximately 50% of the bank's profitability is now derived from transactions with clients outside of Quebec. Within the context of a complex economic, regulatory, and competitive environment, the bank succeeded in improving its capitalization during fiscal 2014. In fact, our ratio of common equity tier 1 capital relative to risk-weighted assets rose from 7.6 in October 2013 to 7.9% at the end of fiscal 2014. Moreover, the Board of Directors has increased the dividend on common shares on 3 occasions recently, in December 2013, in June 2014, and again in December 2014 for its part. The dividend payout ratio remained close to the lower limits of our internal policy on an adjusted basis. Over the past 5 years, the bank's quarterly dividend has thus increased by 50%. Finally, in recognition of the bank's profitability, the solidity of its balance sheet, and the effectiveness of its business plan, the DBRS rating firm raised our intrinsic credit rating by 1 point this past fall to A low. On February 26, we announced our results for the first quarter of 2015. From that period, net income had totaled $35.8 million or $40.5 million excluding adjusted items. For their part, adjusted earnings per share and return on capital were 1.32 and 11.3%. These excellent results first quarter were negatively affected by the Bank of Canada's reduction of the prime rate for an amount of 4 cents per share. However, this is a temporary impact that should be completely reversed over the coming quarters. As it does every year, the bank has set financial objectives for fiscal 2015. These include increasing adjusted diluted earnings per share by 5 to 8% and achieving an adjusted return on common shareholders' equity of 12% or more. Our objectives also call for an efficiency ratio under 71%, positive adjusted operating leverage, and a common equity tier 1 capital ratio in excess of 7%. In the midterm, thanks to our strategies and solid foundations, our goal is to achieve annual growth of our net income per share of 5 to 10% and to improve the efficiency ratio below 68%. To succeed, we will ensure that our operating leverage remains positive and we will maintain capital ratios comfortably above regulatory requirements. In conclusion, I must say that we're satisfied with our results both in 2014 and for the first quarter of 2015. At the same time, we're confident with respect to the organization's future development.